Thanks for joining us today. Phil Argue from SIA. They're our institutional investment partner, as many of you guys know. Worked very closely with them for a number of years. Wanted to spend some time today just talking about, how we've approached Q1, how we're looking at the rest of the year, and then obviously, address the big elephant in the room, what the hell is going on and, how do we deal with this? The tariffs, the back and forth news. So I wanted to have Phil, spend some time today to really just try to unpack that the best we can. At the end, we'll open it up for a Q&A. If any of you guys have any questions, feel free also just to send it into the chat as we go. So Phil, welcome. Thanks for joining today.
Yeah, my pleasure. Thanks, Carl. So listen, I'm just going to preface this with we've had a lot of developments over the last 7 days. So I do have some material that I think will be beneficial just to kind of park in the back of your mind of how to kind of handle these sort of events.
Yep.
And I'll share what we've done, like as Carl mentioned in the first quarter, what we're looking to do in the weeks ahead. But most importantly, I think it's maybe more valuable to emphasize if you have a question, by all means, I'm more than happy to turn off the slides for a minute. We just have a conversation and address what some of your concerns are. But most importantly, that's what we're here to do. So I'm going to share my screen. I'll go through a couple of slides just to give you a sense of what we're, what's transpired, what is working, what hasn't worked, and kind of go through just to give you some perspective. So give me one sec. Let me get this other thing up here. Okay. So probably the most important takeaway, I would say, for investors in general, is this point on the main slide here, is that diversification is working quite well. Okay. If you go back to the last 5 years, unfortunately, it's really been this environment where the more U.S. large cap, the more of the Magnificent Seven stocks you own, if you own more Apple, if you own more Meta, you performed better. This year, it's a bit of the opposite, and this is normal. This happens all the time, but diversification is working. So again, as I mentioned to Carl, I think before we jumped on here, given everything that's happened over the last couple of days, our slide presentations are changing by the hour around here. So I just cobbled together a few things that I think are important for everybody to think about. What are some of the key variables that are going to shape the path of where this whole thing goes around tariffs? And then I could tell you, then we could dive into what we've actually been doing and are looking to do going forward. So last week, I believe it was on Thursday or Friday, we put out a piece of content, a video highlighting this chart. And what you're looking at here is the 1 day change in the S&P 500 going back to 1985. And starting last week, if you looked at Thursday and Friday of last week, we actually had the one of the worst 2 day declines in the S&P 500. So it was the fifth worst 2 day decline. And the point of the slide is that the biggest up days occur in close proximity to the biggest down days. And you can see this during COVID was this red blob over here on the right, the financial crisis, and then right after Black Monday in 1987. And then lo and behold, they said to update this yesterday, because yesterday the stock market, responding to Trump's message on Truth Social, stock market was up 9.5% yesterday. That was the third best day since 1995. I'm sorry, 1950, excuse me. So the moral of the story here is when things start getting like this, we have a natural reaction to take some action. We want to do something to gain control. And oftentimes in these environments, it's probably the last thing you want to do, because most likely you're going to react to what happened yesterday. And just like we saw yesterday, the biggest moves in the market often come right after the biggest down moves. So what's important is to stay disciplined. Oftentimes that means sitting on your hands a little bit, and it may feel uncomfortable, but oftentimes that's the best thing that you can do. Other thing, just to give you some perspective here. So the volatility index, if you're not familiar with it, this basically moves in opposite with the stock market, but it's a gauge of fear in the stock market. This is what it looks like going back to 1990, and you can see we're over here on the right. I tagged it tariff tantrum. I don't know, this somebody in the media will give this period a name, a better name than what I provided it. But looking back in history here, I marked every period where the VIX got above 40. And so the most recent time was during COVID. We had a flash crash in 2015 that lasted a day. So that was that. You may remember back in 2011, we had the European debt crisis. This is where we were worried about Greece and Italy and Spain being able to finance their debts. Obviously, we had the Lehman collapse and then WorldCom 9/11. And so importantly, these days are extremely rare. I should say, yeah, let's call it extremely rare. They represent less than 3% of all trading days over the last, call it 35 years. And so you'd initially say, gosh, you look back at these times, you go, man, those are pretty scary. But if you were able to, like I mentioned, sit on your hands a little bit, not lose your cool. This is looking at every one of those days that was on the prior chart. So every day going back to 1990. And I basically drew the line at 40, like I did on the prior instance. All the days where the S&P 5 or where the VIX is below 40 are over here in gray. And just to orient yourself on this, the VIX level is on the horizontal axis going across. So the higher the VIX goes, we go further over to the right. On the left-hand side, we have the return for the S&P 500. So the broad stock market 1 year into the future. Okay. And what you'll notice is generally as we go higher in the VIX to the right, forward returns go up. And so when the VIX is below 40, we average kind of the long-term average for the stock market, 9.3%. When we get above 40, the 1 year forward return is close to 33%. So in these times where their uncertainty is high, there's always something that's a little scary out there. It pays to stay the course, and we'll get into exactly what's going on and what happened yesterday and what our take is on tariffs and whatnot. But importantly, when we get shocks like this, oftentimes the worst thing you can do is try to satisfy that urge to gain control and take some action. Speaking to the diversification piece that I mentioned at the beginning, this is largely a U.S. stock market correction that we've seen. Now, these charts that you see here, these are through Thursday, so I haven't had a chance to update this. But if you look at what we're looking at here is international equities on the left-hand side here relative to U.S. stocks. So beginning of the year, international stocks were on a tear, right? They did phenomenally well, up about 6%, while U.S. stocks were down close to 10. Now, again, this was through Thursday, so things have changed a bit, but still, international stocks outperforming. If you own a balanced portfolio and you own fixed income has been a great diversifier. So It's not like what we saw in 2022, which was where both stocks and bonds fell because we were worried about inflation. This time around, bonds are providing diversification, which is a great thing, which balances a balanced portfolio. And then the other thing is, if you look at value stocks in gray up here versus growth stocks, this has really been the growth stocks in the US getting hit the hardest. So that Magnificent Seven group that I talked about, Apple, Nvidia, Microsoft, that group's down 27% year to date. Whereas value stocks are down, as of this morning, 6, 7. So having a balanced portfolio has worked out well. I think it certainly will continue to, even when the market bounces and we put this thing behind us. So let's talk about what has transpired in this situation that we're in. So before we get to the exact policies, let's just recap just where the broad economy was 6 weeks ago, because I think it's important to kind of recognize, unfortunately, oftentimes people that are running for elected office, you've got to make things seem worse than they are because you've got to come in and solve the problem. Um, if Donald Trump came out and said the economy is phenomenal under Joe Biden, but I want to but elect me instead, that doesn't that's not a very good message, right? So you've got to point out the problems, and but by and large, the economy is in good shape. Depending on what transpires here with with tariffs and whatnot. And the point here on the left hand side is GDP growth. Okay, so this is updated as of a couple weeks ago. If you looked at GDP growth, this is for the fourth quarter of last year, so we don't have the first quarter yet, but the first quarter is going to be a good number. But the economy grew at a 2.5% clip, which is largely in line with where we've been for the last 10 years, barring the big jump coming out of COVID.
Yep.
So growth has been good. And nominal growth, the growth that you hear in the news when somebody announces, hey, how much did the economy grow? They give it you this real number, 2.5%. That accounts for inflation. But if you just account for the pure dollar amount of GDP, it actually grew at 4.8%. So that is a healthy level of growth for the U.S. economy. So we're in a good place. The other big factor that's out there that is the Federal Reserve. So on the right-hand side, obviously the Fed raised rates substantially in 22 and 23 to get a hold of inflation. They've eased off a bit. So they've lowered interest rates 100 basis points or 1%, and they're sitting on hold. The important thing here is they have a lot of room to lower interest rates if the economy does weaken. If these tariffs go into effect, if we need to, they could lower interest rates substantially and provide some relief to the economy. The one challenging part with that, though, is that inflation is still a little bit of a sticking point. So both headline CPI, so this is the number that we all feel, is running at a 2.8% year over year. The measure that the Federal Reserve cares about is what they call core PCE, which kind of strips out energy, food, some of these more volatile items. It's also running at 2.8%. So their goal is to get inflation down to 2, which is why they've been holding steady, hoping that inflation is going to continue to fall, which we think it is going to. But they may wait a little bit before lowering interest rates to make sure that inflation is in fact going lower. So that's where we were before, let's call it, beginning of March, when sort of the narrative around Trump's priorities kind of shifted. If you go back to February, just to put a point in your mind, Trump was spending most of his time talking about investment deals with large tech companies, how much money is coming into the U.S. in building data centers, and he actually rolled out an enormous $500 billion program with Oracle, NVIDIA, and OpenAI. And actually, the stock market had 5 all-time highs in February. Starting in March, the narrative started to change, and he started to emphasize, less of the let's make a deal and more of we're moving forward with tariffs. And this is probably the biggest. This slide here. This is the big question mark, and this is what everybody is wrestling with. This is what the market is wrestling with, and the challenge is. Trump has laid out a number of goals for tariffs, and we give a couple of examples, and I won't read all of these here, but the gist is, are tariffs a negotiating tool? So we're trying to get these other countries to lower their trade barriers so that our companies can compete in their markets. That's a great outcome. If we can do that, that's great. The other thing that he's mentioned is that we're using this as a source of income tax to offset his tax cuts, right? He needs to get his the Tax Cut and Jobs Act that he rolled out. His prior tax cuts from his first term are up to expire. He's trying to get those extended, and he needs to get something to offset the cost of that. So using tariffs as a source of government income. He's also mentioned trying to balance the budget via tariffs. And he's even gone as far as to say, hey, we're going to get rid of income taxes, which I'll share something on income taxes here in a minute. But again, there's confusion about what the goal is. If tariffs are a negotiating tool, this all goes away. If it's a source of government income, okay, that's going to be a little bit of a challenge. That's a tax on people that are moving products in and out of the country. And then the last thing is tariffs are an instrument to reshape the economy. And this is something that's going to take quite some time. Obviously, he's got a real soft spot for manufacturing. He wants to bring back, manufacturing to the U.S. I'll share some data on that here in a few minutes. But the question of which one of these priorities wins out is the biggest factor in our mind. And what you saw yesterday is Trump goes on Truth Social, says, "Hey, we're gonna put a 90-day pause on the tariffs so that we can negotiate." We got this box up here, and the stock market cheered, right? But we're not out of the woods by any stretch of the imagination. We got a 90-day reprieve. We still have enormous tariffs on China, and so he's still got to weigh these three boxes. What are we trying to achieve? Just some information on sort of trade data across different countries. This is just looking at exports as a percent of GDP, as the size of each of these economies. So we're way down here at 11%. So our exports are a relatively small part of our GDP. Most of our economy is based on all of us consuming things. Going to buy another a washer and dryer, or going to a restaurant. Exports are only 11% of our economy. They're about 20% of China's, down quite a bit from where they were 10 years ago. And then you've got Canada, Mexico, in Germany. They all are heavily reliant on exports, right? So the theory here is they're more reliant on trade, and so Trump, looking to apply leverage and make a deal, apply tariffs to everybody that needs trade more than we do, and we could use that leverage to make a better trade deal. At least that's what if you read through the tea leaves, that's what he's been pushing for. Particularly with Canada and Mexico, main point here is most of their exports come straight to us, right? So they are extremely vulnerable to tariffs that are aimed to penalize them, both Canada and Mexico. So obviously they are quick to try and negotiate. We also have the trade deal that Trump put in place in his first term that sort of circumvents a lot of the tariff stuff that's put in place. But increasingly, it looks like this is mainly focused on China. The message that Trump put out yesterday, everybody else gets a 90-day reprieve, but we're upping the tariffs on China. So it seems increasingly clear that this becomes more of a us versus China situation, which is good because it sort of de-escalates things with other countries and sort of slims down the problem a little bit. Just to put things into context of kind of some of the numbers of what we're dealing with. So let me start with the numbers on the right-hand side. So just to put things into context, over the last 12 months, the federal government brought in let's call it $5.3 trillion of tax receipts, of income. Mainly, most of it comes from income taxes, a little bit from corporate taxes, and tariffs are this number down here, $87 billion. Now, what Trump has proposed, and just as a point, that over the last 12 months, we imported about $4 trillion of goods, okay, in total. So what Trump has proposed is the graph on the left-hand side. This is if all of the tariffs that were proposed on last Wednesday, now they've all changed, unfortunately, but what he proposed was taking our effective tariff rate to 22%. Okay, so we went from 2% to 22%. If you apply just that simple, a 20% haircut on $4 trillion of imports, the government should bring in about $800 billion in tax revenue. However, that doesn't account for behavioral changes. hey, I'm not going to import from Vietnam because now they have a higher tariff. I'm going to go import from Malaysia because it's lower. Or hey, maybe I don't buy that washer or dryer because it's now more expensive. It's almost impossible to account for exactly all of the behavior that everybody who's importing and exporting and every consumer is going to adjust to. But this is the part that kind of spooks folks, is that we're taking about an $800 billion tax on the economy. And that if you apply it to how big is the US economy, the US economy is just shy of $30 trillion. That's about 2.7% of GDP. And as I mentioned, a couple slides ago, the economy is growing at about 2.5%. So that starts to become a problem. Now, they probably won't get the full $800 billion. It'll be less because people will change their consumption patterns. But that's what has got everybody concerned. Obviously, that's why recession risks are rising. So that's sort of the background math on what Trump has sort of proposed. It's obviously a moving target. Just a point here on manufacturing, which is one of those three variables that may be driving, the driving force with Trump's policies. Looking at manufacturing jobs in blue relative to total jobs in gray. This is as of the latest jobs report. So this year, 2025, if we went all the way back to 1939, so as far back as the Bureau of Labor Statistics kept records, manufacturing jobs used to be 30% of the economy. Now they're just 8%. And Trump has got some nostalgia for what the U.S. economy looked like back in the 1950s or whatnot, where manufacturing was a bigger part of our economy. The problem is, obviously, is it just the income differential between hiring somebody in a U.S. factory versus hiring somebody in Mexico, Vietnam, Malaysia. So on the right hand side is average salary of a production employee in manufacturing. Call it low 30,000s. Versus somebody in Malaysia, Vietnam, Mexico, they're working for a fraction of that, right? So if you're going to try and make this math work, where you're going to try and make the cost of importing from these countries equal the cost of just building it in the U.S., you probably need these substantial tariffs, which is what he rolled out. Where this thing goes from here, we've got kind of 4 different scenarios that we're kind of war gaming with our investment committee about which way this thing breaks. Top left box, Trump pushes back from the table and says, "Okay, never mind on tariffs. Market breathes a sigh of relief." We got a hint of that yesterday. We'll see. It's going to play out over the next 90 days. Realistically, we're probably one of these more sort of neutral boxes. So this is the good outcome in the top left. This is the bad outcome in the bottom right. And then we've got a couple of tweeners, if you want to call them that. So good outcome, tariffs are repealed. Top right, tariffs are in place at a lower amount, and the economy can withstand it. If it's not the monster tariffs that he announced on Wednesday, the economy can absorb it, especially if they pass tax cuts. That is what they're also working on, but it's slow because it's got to go through Congress. Other aspect here, we could get tariffs repealed, but markets are still a little jittery. This is a whole lot of uncertainty. And unfortunately, Trump likes to be the guy. And so sort of the uncertainty is something that probably just doesn't disappear right away. The worst outcome is what everybody was worried about last week is we put these monster tariffs on, the economy recoils, and we do experience a recession. We don't know which way of these 4 boxes it breaks, or which one we're going to land in, but we think ultimately the question is which of those 3 priorities win out for Trump? Is it the negotiating tool? I don't know if I can get back to it. Is it the negotiating tool? Is it, are we trying to actually generate income for the economy? Because that's a tax, so it's going to hurt. And then if we're going to reshape the economy, that means we keep the tariffs on as well, because we've got to change, corporate behavior. Instead of offshoring everything, they need to reshore. The downside is that's going to take a couple of years to do. So those are the three things that I think that's the most important variable. We have been of the camp that this is a negotiating tool. He was trying our conviction in that view the last several days, but came back around yesterday. We still think this is a negotiating tool. And look, I think he's a deal maker to an extent, whether bluffing or just trying to improve his position. Laid out these huge tariffs, and trying to force people to call and make deals. And I know the administration has said, hey, we've got 75 countries that have called. Unfortunately, I know, well, at least yesterday, the entire European Union voted almost unanimously. Hungary was the only one who didn't vote for it. They voted to retaliate. So I know Trump is saying, hey, we've got 75 countries calling. We know it's not China. We know it's not any of the EU countries. And so I think there's a lot of posturing around trying to get everybody to the negotiating table and him trying to show that he's got a strong hand. Carl, let me stop there. I've been talking for almost 30 minutes. I can talk a little bit about what kind of transpired the last couple of days, maybe but I want to be respectful of everybody's questions if there are any, or if you've got any questions, Carl.
Yeah, I mean, when you talk about tariffs, I guess my understanding is he's trying to generate, part of their proposal was to generate around 1 trillion in tariff income. You couple that with around 1 trillion in Doge cuts, which was like 25% of spend, and then you take that 2 trillion to balance the budget, and then you remove taxes for anyone under 150,000 and lower the top tax bracket. I mean, does that, in your realm, is there any chance of all that coming to fruition? Because based on your numbers, it's, we're looking at like 800 billion as best case, but in order to write the budget of a 1.8 trillion dollar deficit, they wouldn't even be able to get there under that scenario.
Yeah. And look, obviously this bill that is, in Congress that, Speaker Johnson's working on, Trump refers to as the big, beautiful bill. It's still in process. And I haven't seen the latest draft of it, but I know that the tax under $150,000, I know, I think Lutnick, has mentioned that several times. Yeah, that's not I don't think that's a realistic. What he was really trying to do is I think Trump's priority is to get his tax cuts that he had from his first term extended. Yeah. And at least in terms of government accounting, they do this, 10-year, sort of projection of what that's going to cost the economy. And at least in terms of Congressional Budget Office, sort of accounting, they look at that as, those tax cuts are going to expire, even though they haven't expired yet. So they see that as a tax cut in the Congressional Budget Office sort of accounting. So I think what I fear is that if we're going for the income, it's income just to extend the existing tax cuts, trying to remove taxes from anybody under $150,000. I know Lutnick mentioned it. I know
he's been trying to hammer it home. Yeah.
Yeah, I mean, look, we've got the no tax on tips, and that one Trump is actually, he's emphasized a number of times. There was also at one point no tax on overtime, but all of these things have to go through Congress, and that is a logjam. So we probably wouldn't have the volatility that we've had if all of this was being done in unison, but Trump controls tariffs through executive order. And Congress has to write the tax code, and those two move at extremely different speeds. Yeah, so that's this. I think the source of uncertainty. I will just mention one thing. I guess 2 nights ago, not last night, but the night before, it sounds like Scott Bessent, the Treasury Secretary, who had been sort of, it seemed like, marginalized during some of this tariff talk, has reinserted himself into the sort of the cabinet's discussions. We did see just overnight on Tuesday night, there was some weird action in the Treasury market. Not anything that would affect our portfolios, client portfolios at all. But there was some odd behavior that was wondering, hey, are foreign countries selling our treasury bonds? There is some technical stuff, a bunch of hedge funds that invest in a certain trade that people were worried about. Whatever it was, it got Scott Bessent, who is much more of a moderate and has got sort of a moderate plan to implement some of Trump's plans, brought him back into the table. And so we've got sort of within Trump's cabinet, we've got Peter Navarro, Lutnick, Lighthizer on one end that are all pro-tariff. Let's stick it to China. And you've got Bessent, who's a markets guy who understands, hey, you can't just do this all at once. And there's a bit of a power struggle happening behind the scenes. So obviously, Scott Bessent got a little worried, got Trump's ear, and got the 90-day extension. And so hopefully we're going to have a more thoughtful approach, in the days and weeks ahead.
So with that, I think we can transition, what have you guys been doing kind of leading up to this, as far as, in Q1, just portfolio strategy, and then, what has the investment committee, thought about as far as an approach to, where we're going,
Yeah.
in the quarters to come.
So, let's start with what we've done already. So, in early March, we had taken the step to remove. We have for a long time had an overweight to U.S. equities. So, all of our portfolios are globally invested. So we own U.S. equities, we own international, we own a little bit of emerging markets. And over the course of time, what we're trying to do is trim a little bit from one area that we think has maybe got less opportunity, overweight another area, so shift some capital around. And over the full market cycle, our goal is to outperform just owning a standard balanced portfolio. And so for the last, really for the last 15 years, it has been all U.S. equities that has outperformed. And actually, I do have a chart of that. And I apologize, some of my charts are kind of all over the place, but let me see if I can jump forward to just to give you an example. But so let's see if I can, here we go. So something like this guy. Okay, so this is looking at the last 15 years. Now it's right after the financial crisis. So obviously it's kind of a low point in the market. But what we're looking at is US equities in this dark blue here, relative to international equities, which is this gray line here. It has been the last 15 years have been a one-way US outperforming everybody else pretty much nonstop up until February. And so this sort of relationship between international equities and US equities started to flip. And so we took about 10% of our US equity exposure and moved it overseas. So that was fortunate. International equities, as I mentioned kind of earlier, are basically flat on the year, where US equities are, at one point we were down, 18%. But like I mentioned, international equities were basically flat. So one of the big variables that are out there that kind of drives what are some of the decisions we're making is what is this relationship between, is US going to continue to be the center of capital flows from around the world? Or do we go to an era where international markets start to outperform? International markets basically have gone nowhere for, since 2007. And actually, since if you went back to, October of 2007, before 2008, international markets have been flat for 17 years. So their valuations are extremely cheap. There's a lot to like about some of these international markets. And now you've got these other countries that are deciding to increase deficit spending to rebuild their military, obviously in Europe. You've got China, which, I mean, the trade issue is kind of a non-starter, but they're starting to stimulate their economy as well. At the same time that the US, we're trying to rein in our deficit, right? So the big question in our minds, and we're trying to figure out, is this huge run of outperformance simply the fact that we've been running these extraordinary deficits. So here's the deficit as a percent of GDP. We're running a 7% deficit. When everybody else was trying to be fiscally responsible, we're trying to shrink the deficit while everybody else is ramping theirs up, and that we think that likely leads to better returns internationally. So that's what we did. That's what we did in the first quarter. So to where we go from here, that I don't have a slide for you, but I'll let me stop the screen share here, but I can just speak to it.
Yeah.
So first of all, as I started at the beginning of the presentation, equity markets have been extremely volatile, and we are, by most measures that we track, extremely oversold, even regardless of what happened yesterday. So we're expecting a bounce, probably a pretty meaningful bounce, not just a one day. We think things get better over the next 60 to 90 days. We're going to have this looming worry about what happens in 90 days, where these tariffs going to be back on. But I think the composition within equity markets, what starts to perform better, is going to be very informative to, okay, is this going to stick, or are we going to get a bounce and maybe we've got a challenging market ahead? And when I say a challenging market ahead, I'm talking about over the next 6 months. Going back to when we get these volatility spikes like this, if you could close your eyes for 12 months, we're going to be fine. This is probably a great opportunity.
Yeah.
In the interim, though, we're trying to move things around and adjust portfolios to smooth out the ride and take advantage of opportunities. And I think we think the opportunity is going to present itself in the next 6 to 8 weeks. Does this whole situation go away, and hey, we get to a comfortable place with tariffs, and then we look to, okay, where is the leadership? Are we going? Is it back to Magnificent Seven U.S. large cap growth stocks? We'll capitalize on that. If it's not, if it's something else, we're in a position to pivot. So I think right now is not the time to jump around, because markets are oversold. We'll get a bounce, and then once we bounce, what's the composition of that bounce, and which way do we pivot from there?
I mean, do you expect, the most likely leaders again to be your big tech? Obviously, they probably can navigate the situation a little bit better than others, or you think the leadership changes, whenever that bounce does come?
So I historically, when these sort of events happen, the real big leadership changes happen on the eve of a recession. So if we went back to 2007, it was energy and financials were the big star performers during that cycle.
Yeah.
And since then, they have not performed as well as owning tech. And so we can go back through history and look at this, where it's almost a binary outcome. If we have a recession, people will start to, obviously people get concerned, they start selling. And given the amount of capital that is tied up in those 7 stocks, it was 40% of the U.S. equity market was in those 7 stocks. They're probably gonna see some pain. They're also richly valued, and they're also heavily dependent on international revenues. So you take the Mag 7, I believe 40% of their revenues come from overseas, and at the moment, nobody has gone after services. So all of this trade tit for tat is all just about goods. How much nobody's going after licenses of Microsoft Office or Google search revenue. So that's a benefit, but they are exposed to these other countries. So I think if we go back to the cycle isn't over, large cap growth likely outperforms, but we were seeing some behavior within U.S. and international that gave us pause. Plus, what the Europeans are doing in terms of stimulating their economy at the same time we're trying to rein ours in terms of fiscal spending. Said, okay, hey, let's take our international overweight off the table temporarily. Let's assess, see where things go. If we don't have a recession, I think it's U.S. equities outperforming. It's probably large cap growth. It's the Magnificent Seven. And we'll look to add to that, if the dust settles in favor of that outcome.
Let's go the other route. Let's just say a tariff source of income. They're going to be stuck on longer. How are you guys thinking about that called bottom right box in the more worst case scenario? How would you guys try to pivot the portfolios under those circumstances?
So in part, we're have been anticipating this for not I shouldn't say anticipating this. When we start to go towards a recession, usually what happens is you start to see problems in the bond market first. And typically, the bonds of low-rated companies are usually the first to get hit. People start to worry, am I going to get my money back if I lend my money to, some, smaller business, not Microsoft or one of these big multinationals. So we have had a significant underweight. So we've taken a lot of what is usually goes to high yield bonds for us, and we put it with more high quality bonds. So with our core managers who are managing things like mortgages, treasury bonds, high quality corporate bonds. So in a sense, we are defensive within our fixed income exposure, and we would expect credit markets to be sort of the leading edge of that. Up until Friday, credit markets were almost oblivious to what was happening in equity markets. So credit markets were very benign. Everything was a-okay. Friday was the first day that we saw a little bit of a jolt. Nothing like what we saw in 2022, nothing like what we saw during COVID. But it was noteworthy. If that were to keep going, you'd probably see us shift more towards defensive US equities. So rather than having relatively sort of a balanced approach between growth and value stocks, we'd probably go more towards value, and we'd seek out companies that are more defensive in nature. So you want to own consumer staples. You want to own Coca-Cola, right? Instead of owning General Electric, an industrial name. So we have an entire playbook that has got several different scenarios of which way this thing goes and how we adjust. Given the unfortunately the uncertainty about this whole thing, it's hard to really say which way it goes. I could say that at least as far as the data that's out there, if you tune out the media and Truth Social, the economy's okay. Like this is a headline scare. We're threatening to put some pressure on the economy, but that sort of downside scenario, the usual things that you would see aren't happening at the moment. So I think this is more of a policy brinksmanship position that Trump has put us in. And look, hopefully he makes some deals and we all come out of the other side of it better. But if things start to deteriorate, I think that's where you'd see us shift to. Probably more international equities versus US because they're cheaper. Within the US equities, we get more defensive, think consumer staples, utilities, healthcare names, healthcare. I guess that's one other thing I didn't mention. In March, we had a consumer discretionary position that we sold in favor of healthcare. So we'd probably add to that. Most healthcare names, they're not importing. A hospital isn't importing goods and services, whatnot that are impacted by tariffs. Their suppliers may be, but that seems like a place where we can hide out. So anyway, Carl, is that helpful?
Yeah, no, that's helpful. As we round up here, I've been going for a bit. If any of you guys have any questions, you want to send it into the chat. I'll give a few minutes here. And then, Phil, are you guys considering ever implementing, any alternatives like gold? I get that question. And then, under what scenario, if you guys would you guys maybe raise cash levels within the portfolio? You guys thought if things do get worse, or is there a pinpoint that you would look at to say, hey, we need to really, hide out right now?
Yeah. Okay. So on the cash level first, so first of all, let me start by just saying we have a very strict investment mandate. So it's not like we could just say, hey, all of a sudden, hey, we're going to sell 50% of your portfolio. So on cash, we don't have the flexibility to go, sell everything and go into cash. Like that's not going to happen. But what we have done in the past, and what we could do, is we would buy short-term treasury bonds. And so we did that briefly during 2022 and early 2023 when the whole Silicon Valley Bank debacle kind of went off and the Fed was raising interest rates. We did own short-term floating rate treasury bonds that pay out a higher coupon as the Federal Reserve was raising rates. So we've done that in the past, and we've had a healthy allocation to that in the past. Gold, we have looked at it a number of times, and if we were to see let's say a 10% correction in the price of gold, it would probably be something that we seriously consider. It's had such a good run over the last 2 years.
Yeah.
I mean, we talked about 2 days ago, we had an investment committee meeting and it was a topic of conversation. It's obviously a desired asset if we are going towards that red box outcome. But it has performed exceptionally well over the last 2 years. And so that it does kind of keep us on pause, especially if we do get some sort of strength in the dollar, which isn't happening the last couple of weeks. Usually gold prices go opposite of the dollar. At least Trump's plan was, hey, we're going to put these tariffs on. Our currency is going to appreciate relative to foreign currencies. That should have put downward pressure on the price of gold. It's actually been the exact opposite. The dollar has fallen, gold has rallied. So something that we look at, it would certainly be one of the things in our toolkit for the downside scenario. Keeping an eye on it.
What about on the upside? If things do clear out, do you ever envision, obviously I'm sure you get asked this often, but maybe in the growth oriented portfolios, like a, allocation towards a crypto, like a Bitcoin or something to that extent. And again, that's assuming things improve, but have you guys looked at that in some of the growth allocations, broadly?
Yeah, so crypto we've not. Right or wrong, I mean, we tend to take a more conservative approach, and the crypto is obviously now with the administration getting behind it, it's not going anywhere, and it's becoming a much more mainstream asset class. So I know that it has come up. It is not something in our mandate that we haven't written it into the rules of our portfolios that we can do. So near term, it's not something that's gonna be a part. At some point in the future, I could certainly see it happening. But at least up until the last 6 weeks or so, if you looked at the price of Bitcoin relative to, let's say, the NASDAQ, it was sort of just a leveraged NASDAQ vehicle.
Yeah.
However, I will say over the last 6 weeks or 8 weeks, it has held up extremely well. So it's something we watch. If it gets to a point where it provides a diversifying benefit to just owning, the Magnificent Seven large cap, growth stocks, yeah, absolutely, we would look to incorporate it. I think this is one of the first, real tests now that it's available through ETFs, and a lot of investors have got exposure to it now. This is one of the first real tests since it's been mainstream, and so it looks interesting. We're not going to touch it in the near term, but it wouldn't surprise me if that's something that is in our toolkit 12 or 18 months down the road. It's possible.
Yeah, I mean, I bring it up just because you get the question, asked pretty frequently. I know obviously the challenge is just how you model in that volatility. And a lot of times people don't realize it, if you did a 3x NASDAQ lever up against it, you would see very similar returns over the last couple of years. So with that, folks, does anyone else have any final questions we want to send in before we let Phil jet here? Afterwards, guys, if you guys do have any questions, feel free to reach out to me. We certainly have SIA as a resource. One to make this call available to everybody. And I certainly look forward to seeing each and every one of you guys when we do our quarterly review. Phil, thanks again for joining us and your time.
My pleasure. Thanks, Carl.
All right. Have
Take
a
care.
wonderful day, guys. Take care, everyone.